Welcome to The Patient Physician. I'm your host, Paul Smith, joined today by my co-host, Chris Fulbright.
How
Good
you doing,
afternoon, sir.
Paul?
Is it afternoon?
Somewhere it is. We're going to count it as afternoon. Depends on when they're listening to the podcast. So we'll just say good afternoon, good morning
I'm
to everyone.
struggling because, I just came back from a trip from Hawaii, which is
Yeah,
gorgeous. I know you've been there. I don't know if you regret the time change like I do. It's just, I'm still adjusting. If it wasn't so beautiful, it'd probably be one of the most deserted islands ever because it's just a tough change.
you have to remind
Anyway,
yourself. Just look at the pretty photos and remind yourself what the 17-hour flight was worth. That's what you have to do.
right. And
Yeah,
why did I come back to have to deal with the 5 hour
that's right.
adjustment? It's like
That's
middle of
right.
the night for me, maybe. Who knows?
Who knows?
Anyway, well, good to see you. Today, we're talking to Tony Kruse with First Horizon Bank, and we're going to dive into home buying and all the questions people ask when they come out. And I would say, Chris, it's probably one of the first things that as residents are finishing up their training, they get their new job, they're
That's right.
going out into practice. This is like once they get their bearings about them, and sometimes even before they even get settled, they're shopping for homes, right?
100%. Right. It's coming out. We're having conversations. Student loans, buying a house. How do I refinance this? What is it going to look like from an income standpoint? They've heard some things. They've started Googling debt to income and how do we handle these scenarios. And Tony and his team have done a phenomenal job helping many of our clients both educate them and help them just feel very prepared buying a house, comparing different interest rates, new homes, used homes, renting, buying different things, as well as some specific physician loan or what they may see as doctor loans, if they're depending on who they're googling out there. Very specific programs which help physicians purchase a home. So we're super
Yeah.
excited to have Tony on here. Just a wealth of knowledge. He's been a great asset to many of our clients.
Well, hopefully we'll be able to add some more insight and information and education. And so with that, we welcome Tony Kruse to the show.
Hey guys, thanks Paul. Thanks Chris for having me. I'm excited to be here.
Thank you,
Awesome. Well,
sir.
thanks for carving some time out.
You bet.
Will you jump in and just kind of give us a little bit of your background and what brought you to do what you're doing today? And then we'll jump into some more meatier topics like the current interest rate environment and home buying.
Yeah, for sure. Chris's nice way of saying he's a wealth of knowledge just means I'm old. I've got I've got 31 years this month in mortgage lending, and it's crazy to think that it's been that long. But at the same time, I've seen everything under the sun, and it gives me, as Chris says, the wealth of knowledge to be able to help these folks. I got started in lending right out of college in 1994, and I've got a BSBA in finance and banking, and I grew up in a small town in Iowa, and my mom is one of 17 children. So I've got aunts and uncles, cousins, just everyone you can imagine in my hometown knows me. And so the banks were really jumping on my resume right away because they wanted me to go get all my relatives for bank customers. So
Right.
that's how that started.
Basically the whole town.
The whole town
Exactly.
there. Yeah.
Exactly.
Your
I mean
family
that's
owns the town. We'd like you to talk to them.
Welcome to Cruzville. That's right.
exactly. So I wanted something bigger in my life than small town Iowa, and my wife and I made the move down to Dallas in '98. Got on with a Fort Worth mortgage in Fort Worth, and then um, I'm currently have been at First Horizon for 19 years now.
I'm kind of curious what makes someone like yourself want to switch lenders or banks. I mean, is it location or opportunity?
Well, when I was at Fort Worth Mortgage, I was more inside sales, and Fort Worth Mortgage was a large servicer of mortgage loans. And so people that wanted to explore lending possibilities would call in, and I was basically an order taker, right? I was answering the phone and just answering the questions that they wanted to get knowledge about. I wanted to be more outside sales. So when I did that, I came out to a very small company in Dallas and started my career in outside sales where you're generating your own business, and have just been able to build my business since then. First Horizon has been purchased 2 different times, And so I say with First Horizon for 19 years, it's been two other banks. The reason I came on with the bank was originally called Pulaski Mortgage out of Little Rock is because of their products. They didn't have a physician loan at that time, but they were very well known to have some portfolio loans that we keep in the bank that were very open for things that you couldn't get done on the regular traditional guidelines that every other bank or mortgage company had. And so to have a toolbox that allowed you to help people that maybe couldn't always be helped, for instance, people that have been self-employed for less than 2 years, traditionally that's a no-no, and it's very difficult to get finance for that. Pulaski Bank had those programs. We were bought by Iberia Bank, and they continued with those programs. And then finally, we're here at First Horizon, who've just continued and added on to the programs. We've had the physician loan now. It started at Iberia Bank, but First Horizon kept it and only has enhanced it. So the beautiful thing about these banks that have purchased us is we've always had the larger mortgage company. We've always had very good customer service ratings. So I've always had the same bosses over the 19 years for the most part. You know, we've got their ear, they're here for production. And so it's been a really good partnership. It feels entrepreneurship, and they just let me go do my thing. And that's great. They give me the products and the backup to go get it done.
That's great. Well, thanks for the backstory there. You brought up the physician loan. Obviously, predominant number of our listeners are physicians. Can you walk through that a little bit? Maybe talk about some of the details, maybe what First Horizon, obviously what you and your team provide, and then some other things they may see in the marketplace. Because I would imagine maybe each bank, each mortgage company does things a little bit different, whether it be the underwriting, loan forbearance, 1099 income, those types of things. Can you tell us more about your program and how you can help people?
Sure. There's about 5 or 6 things with our physician loan program that I think stand out against others and kind of separate us in certain categories. There's many banks out there that provide these services, but I think ours stands out in some of these ways. One is we have the highest amounts of purchase prices with the least amount down, meaning I can go up to 1.5 million on a sales price and have 0 down for a physician. And most of the competitors are going to cap that out at either 750 or $1 million. I've seen one other competitor maybe at 1.2, but to be able to go up to 1.5 in this environment, especially in North Texas or Texas in general, Florida, where we do a lot of lending, you've got these entry level homes that are higher than they've ever been. And for a physician coming out and maybe saying, I'm having my first attending job that's going to pay me X, but I've had the residency job that's paid me $65,000, $70,000 for the last 3 years. They just don't have a lot for down payment. And so for us to be able to go up to 1.5 million on a sales price with 0 down really helps that physician getting started out. We'll go up to 5% down, up to a $2.1 million sales price. And then above 2.1, they're going to ask for 10% down. So whether you're just getting started out of residency, or you've been a 10-year attending, we've got the product for you with low down if that's what you wanted. One thing I mentioned is those number of years. Many of our competitors cut off a physician loan if you've been in for 10 years of practice. And we don't do that. The more experience you have, the better. And so we're always going to be able to have that loan, whether you're out 1 year or 25.
So I know one of the parts here that we hear, hey, 0 down, 3% down, 5% down. We get stuck with what on the backside? PMI. Can you talk about the impact of PMI on y'all's loans with those 0 down loans?
Yes, we do not have PMI at all for 0 down or anything up to 20% down, which is a big help as well for that physician. If you compare, say, a conventional conforming loan amount, which the max on that in 2025 is 806,250. If you had 5% down on that loan type, you could have a couple of $100 a month easily for PMI. If you have that minimum down. So to be able to eliminate that and not have that that additional insurance is quite helpful as well.
Yeah. I was thinking through some of the things you helped us with last year. And I don't know if this was a new rule or regulation, but you helped me and I helped a client on this. Is they had signed a contract, were moving to another state, but they hadn't started their job yet. And I was thinking that it was a 90-day window that you could help them with mortgages. But I think, if I remember correctly, you actually could go back, or they could extend that as 6 months prior to their contract or something. Didn't you have a longer window
That's
where
right.
they could actually do that? Can you? Because this
Yes,
is the
yeah,
time.
that's
So one of the things that's going on right now for Paul and I and our team is we're helping so many of our physicians as they're completing their training, starting their career, maybe going on to another fellowship. We affectionately call it exit season during this time period. This is a lot of the times when you see stuff from us where we have our clients are moving to Atlanta, they're moving to Tennessee, they're moving to Cruzville to see your other 17 relatives. And so we have these contracts out there, and that's when I was very surprised. So they may have signed contracts. Likelihood is they have signed contracts now, and they're trying to figure out, okay, how do I go buy that house? Your program is one of those that can help them, correct?
Yes. Yeah. And that's another way we stand out. Besides the loan amounts with 0 down, we also have the longest time before you actually start your job to be able for us to count that income. Anything between 0 and 90 days, it's just regular guidelines. But then we do go out to 180 days before the start of an employment, as long as you have some reserves in what your current debt is and what your mortgage payment would be as well. So let's say you've got $2,000 of debt per month out there currently through a car loan and some student loan payments. And then say your house payment's going to be $5,000. And so that's a total of $7,000. We just want to know that the number of months between the time that we close the loan and the time that their employment starts, that they have that as a reserve. So say it's 90 days and we're talking about $7,000, we just need $21,000 of reserves to be able to extend out to that 6 months. And, most people will have that, some don't, but that's part of the process, and getting them pre-approved is telling them what those guidelines are if they're trying to do something that's outside of a normal 90 days.
Yeah. Yeah. That's excellent. Paul and I were visiting about this the other day is the impact of interest rates, right? We've had just historic rise in interest rates impacting residential, commercial, different things. Can you talk about what your thoughts are around interest rates where they currently are? I think as we look today, they're just below 7 in the typical 30-year. But can you kind of share where you think interest rates are going to go, and then tie that back into one of the questions I get from people is, hey, interest rates are high. Should I be looking at an ARM and take advantage of a shorter period and refinance because interest rates are going to come down because that's what people believe? Or is now a time period where, hey, this is where we're at, a fixed rate may be a good option in that? So I know there's 3 questions in there, but if you can kind of walk through that.
Sure. Interest rates are really difficult to know what's going to happen, right? It's the political climate is going to be a big impact on that. And that just remains to be seen what's going to happen. I was actually on a conference call this morning on a regional call, and they put out some statistics for what Fannie Mae expects rates to be over the next 2 to 3 years. And it's really not much of a decline. If you could get a conventional conforming loan right now for, say, 6.625, they think it's only going to be 0.25% lower over the next 2 years. But again, there's a lot of impact at the political impact on that. So you just don't know. I think that the current administration really wants to have lower rates, and I don't know how they're going to achieve that exactly, but that could happen. So you talk about the difference between adjustable rates and fixed rates. The physician program that we have allows adjustable rate mortgages with either a 5 or a 7 or a 10-year fixed rate, and then can adjust every 6 months after. That's an industry standard now, that they adjust every 6 months instead of a year. And then, of course, we've got our 15, 20, and 30-year fixed rates as well. So if you look at the last, let's just call it the 31 years that I've been in this industry, besides 2 100-year events, that being COVID and the Great Recession, there's been 6 to 7 more times that are just natural ebbs and flows of industry and markets that have allowed you to refinance. And so if you look at that, you say, okay, is a reasonable to think that if I got into a 7-year ARM, I'm going to have an opportunity to refinance within that 7 years to a fixed rate if you're more conservative. And I would say yes. My history says that's going to happen. And so if you look at our 30-year fixed rate, let's say at 6.875, you could get as low as 6% on a 5-year ARM, 6 and an eighth on a 7-year ARM, and 6.375 on a 10-year ARM. And so most of my physicians right now are doing adjustable rate mortgages for either that reason. They feel that there's a reasonable chance that they can get a fixed rate if they want to over the next 5, 7, or 10 years, or they don't know what this first job is going to hold. They may be looking to move. And so they think, if I'm not going to be in this house in 7 years, let's go ahead and get that lower rate. Because if you're looking at sales price today versus 20 years ago, that adjustable rate difference of 7/8 of a point is real money when you're buying $1 million or $1.5 million house, as compared to maybe 20 years ago when it was 350,000. So
Yeah, I
I'm a
just had
big,
somebody doing that. I can't
yeah,
imagine why they would have. They ended up going with the fixed, and I think there's always concern around. Well, rates will be higher when it comes to adjust, and that would be
right.
the natural concern. But that's also assuming that you're going to stay there. I think there's a lot that comes into play that people just assume that I'm going to be in the same job, I'm going to be in the same home. What are you seeing? I think the average, you know, turn on a home, meaning somebody's going to move, whether it's jobs or just move because they want to upgrade or get out of that house. I thought it was used to be like 7 or 8 years. What do you know what the average is that somebody moves just to get out of that house and into a new one?
Yeah, before COVID, it was at an all-time low. It was about a little under 6 years. And this is the interesting thing, what that average is going to do since 2020, because people are hamstrung with these, 3% rates that they have.
Yeah.
And, they're not going to be that low again until there's another 100-year event. And hopefully that's not anytime soon. I think that you should be happy if you could get a fixed rate in the high fives over the next 3 to 4 to 5 years. And I think that's what's realistic. You never know what's going to happen, but in my mind, I think it's a great tool to use as an adjustable rate. And to me, it's all about education. If you're a conservative person that just doesn't want to have that adjustment, option down the road, I get that. But if you're somebody that is upwardly mobile, like most physicians are, that may be in a different house after 7 years because they've gone to just regular progression through your career, I just think it's a great tool to use for that adjustable rate. And about, this might be a skosh high, but I bet 70% of the customers that we're closing are using that adjustable rate right now. So we'll just have to see what happens with the national average with how long people are in homes with these rates having been so low. It's going to go up slightly, but still a lot can happen in one's life in 7, even 5 years. I mean, I tell my customers I should have taken my own advice. I've got 3 children. Every time we had a child, we moved houses, and that was every 3 years. And so I should have been doing adjustable rate mortgages every time I bought a house.
Yeah, it makes a lot of sense. I think it's just the unknowns that make people uncomfortable, but locking into something that's higher and known somehow is easy for some people to rationalize.
Yeah, and I think for a physician, it's probably a little easier to think about that adjustable rate than maybe somebody that is in a different job type that's going to be more fixed income. I just think earning potential has a lot to do with that as well.
Hey, Tony, are the loans specific around this? Is it only primary residences? Can they use it for second homes? Can they use it for other scenarios? And then are they limited on uh, HELOCs or home equity lines of credit if they go through one of your programs?
Yeah, that's a great question. It is for primary residence only. We'll do single family residences, condominiums. We'll do a half of a duplex if, say, it's an attached, but we will not do a 2-unit home. So we're very specific in that. Since we're giving what we feel is a great product with low down and good rates, that we just don't have the unlimited resources like a Bank of the World to be able to say, hey, you could do this for a second home or an investment property. So it is going to be limited to your primary residence. I can get the states if we need to that we're in. But we're limited to lending the physician loan in places where we have branches, and we are also limited to helping people that are within 100 miles of a branch. So, unfortunately, I don't have any branches out in, let's say, West Texas, and so we have to pass on some of those things. But that's something that we talk to people about when we pre-qualify them, as well as where they're going to be, to make sure that we can offer that product.
Is that going to be pretty standard? I know that the regulations around your specific loans, but will people that are going to be in West Texas, as you gave, is that going to be something they would find pretty standard with a bank that's out there?
I think the larger banks that offer these do not have those restrictions. And let me tell you, the reason that we have our restrictions is a couple of years ago, when there's a regional bank crisis, there's 2 or 3 of them that failed. Almost overnight, the regional banks lost billions of dollars of deposits to the banks of the world, that I call them, that shall remain nameless because they're Darth Vader to me. But the fact that we lost so much in deposits almost overnight was a crisis for us. We're one of the strongest regional banks out there, First Horizon, but we lend our own money, right? And so when you lose that deposit, we don't have those unlimited resources to just be able to go out and lend as much as we wanted to. So prior to a couple of years ago, we were doing it. There was no limitation. And moving forward, for us to be able to get rid of that limitation, we have got to get more deposits in. And that's the name of the game for any regional lender. So, I'd be remiss if I didn't mention this. The reason we're doing 0 down physician loans is to cross sell. We want them to have some deposits with us as well, and they'll get some rate reductions if they do have a depository relationship. And it's not anything where on some programs you have to have a certain amount of money locked in there and deposited at all times. Ours just says, hey, if you start with X amount of dollars with us, we're going to give you 0.25% off the rate. And then those funds are free to be used once the loan closes. We just want to get the relationship started and see if we can be mutually beneficial to each other. And so that's unique in that if we're asking for deposits, we're not saying, hey, you have to keep this $50,000 at this balance for the life of the loan. We just don't do it like that. But again, we're trying to get that relationship started. As loan officers, we do a good job of introducing them to private bankers and hopefully getting some deposits. Hopefully in time, we'll get back to where we were or even higher with deposits, and maybe lift some of the restrictions and be able to lend in all of Texas instead of within 100 miles of the branch.
So there's still some reverberations, if you will, from that banking crisis a few years ago.
There is. We got a lot of the deposits back, but we had to pay for it. We had to introduce, money market accounts that were maybe above what other large banks were doing to get those deposits back. And long term, that's not a solution, right? I mean, if you're just doing it based on the rate, at the minute that that 12 months of money market rate is up, if somebody else has a better rate, they're probably going to move that. So there are ongoing reverberations. It's always a balancing act between where you want to be on those depository interest rates that are going to allow you to have the budget to also be very aggressive in the lending space as well.
Any changes you're seeing in the application process? I know the last couple of years there's been some debt to income ratio conversations, higher debts, therefore people are falling out of the ratios. The housing costs are moving up a little bit as a percentage as we look at the formulas. Anything from your experience you're looking and saying, hey, if you're looking to buy a house, look at your credit score now, hey, have these things organized, pay these things down. Any foreshadowing that you can give people and some guidance there?
There have been some things that have loosened up a little bit that, as a result of the Great Recession, there were some things that they just got rid of that they needed to, but then they tightened up on a lot of things that I thought were unnecessary. And so now where you used to have a debt to income ratio for a non-conforming or a jumbo loan that was set, black and white at 43% of your gross income, we're seeing some options where we can have higher debt to income ratios now, and it's at a cost, right? So if you've got a 43% debt to income ratio, say you've got the lowest rate available, you can inch up to 45% and maybe see a little difference in the rate of an eighth percent. And you can go all the way up now to 49% of your gross income for a jumbo or non-conforming loan. And again, that number is anything over 806, 250 this year. And so I like the fact that those are opening up, because quite frankly, you need to have some flexibility when we're seeing these interest rates be higher along with these higher sales prices. And we're seeing a shift right now, at least in Texas, where I do most of my lending, with houses that are on the market. There's more inventory, and a lot of people say, well, that's going to lead to, softer prices. We haven't seen softer prices yet. The realtors that I talk to say, listen, if you treat your house right and get it ready to sell, you're getting top dollar. The houses that are staying on the market are the ones that, you thought you could do when it was 2020 or 21, when you open your door and all of a sudden you had 17 offers on your house. You've got to make it desirable. And so we haven't seen a lot of softening in prices right now, even although the listings have increased. And I'm not so sure that we're going to see much as long as Texas is net positive in jobs, which we have been for every year that I've been in Texas, and we're going to continue to, with the environment of no state income tax and some other benefits that cities will put together to bring businesses here. As long as we're net positive in jobs, I think at least locally in most of Texas, we won't see much softening in price.
Yeah. What I've seen is, as you mentioned before, there's a substantial percentage of homeowners out there that are still in the 2.8 up to 4.5 range that are just holding, because they're going to have the reinvestment risk if they go back out. But then there's also a lot of people that, as you mentioned, that bought houses or investments during the COVID timeframe, anticipating being able to rent them, anticipating the returns that they were seeing or the hyper growth, and those have pulled back. We live in Austin, and so we have seen a lot more houses on the market. There have been some price reductions. They are starting different, but it's really starting different from what maybe someone thought they could get during that COVID spike, rather than if you go back a couple of years, you look at a normal trend within a real estate growth, there still has been that. You just missed out on that one blip, the real big jump during that excited period of time. But I've talked to some real estate agents lately as well, and that's what they're seeing. Still really good volume, people looking at houses, still people out there. And as long as the house is of good quality, as you're describing, taken care of in a good location, same things that have held true, good school districts, good amenities, those types of things, those houses are still moving.
Yeah. The interesting thing with the physician program is that we don't have a difference between what I mentioned for jumbo or non-conforming and conforming loan amounts. So you're going to get the same rates, whether this is an $800,000 property or a $2 million property. And that's another kind of hidden benefit of the physician loan, is there's no difference in rate. Oftentimes you're going to see a difference of maybe 0.25% to 0.5% in really high times between conforming and non-conforming loan amounts. So you don't have to worry about that with the physician loan type. Interestingly, right now, you don't have much difference between a jumbo conforming or non-conforming rate. It's about the same. And that's because these banks of the world, as I call them, that, there's no secondary market to sell these jumbo loans. So they're held in their bank. They have so much cash that they need something to do with it. And so they're putting some interesting and nice rates out there for non-conforming, non-physician loan types.
If they need a bank account number to hold some of that cash, I can give them mine.
Yeah, I do.
So I was going to come back to that. There's actually two questions that I've sort of stacked up here. One, you're talking about the interest rates and the difference. I had heard a while back, and maybe it was from a different lender, that when you do a physician loan, so we're talking about the benefits. What really makes it a physician loan is some, you know, relaxation on putting anything down, maybe nothing down, versus, you know, having to put 20% down to eliminate that PMI. So that's a big benefit. But that PMI was somehow rolled back into the rate, that they were actually going to end up paying a little bit higher than if they just came in and said, I have 20% I can put down. Would they end up in a different rate? Are you saying that? Is that some banks do that?
Some banks will
don't.
do that. Yeah, it just depends on how aggressive their program is. You know, we found that you can't have a premium on price, i.e. interest rate, without having PMI. It's just not going to work. To be at the top of the heap, so to speak, of lenders that are offering physician loans, you can't put that price adjustment in there. So really, and this is going to vary, but depending on the day, we're usually at or sometimes below what a non-physician loan would be for the rate, which is outstanding. And I couldn't believe we were doing, 2.75 on a 30-year fix back in 2021 on these things. It's just, there's no margin there. It was crazy. And while interest rates have just gradually increased because of the markets, the margins in these things are still tight. We're looking at, is it more of a loss leader, if you will, to get some cross banking in there and develop a relationship.
Mm-hmm. The other thing I was going to ask around the debt to income ratio, we spoke with a student loan expert recently and had him on, and just the whole debacle going on with that. I was just curious if that's messing with your debt to income calculation and ratios when you're trying to qualify somebody. Maybe they're not really having a handle on what their student loan payments would be or should. How do you navigate that?
That's
or
a
are you
great
having
question
to at
because,
all?
well, we are, but I think we've been pretty nimble in changing some guidelines to get around it. But you're right. I mean, it's a travesty that people are calling in to figure out what their student loans are going to be, when they're going to come due, what their payments may be, and they can't even get anybody to answer the phone. It's just absolutely ridiculous. So, we've had to deal with some things on our side to say, what can we do to help these folks? And the good thing is, they've got online calculators that are very detailed with what your payment would be if you go to an income-based repayment plan. And so if the credit reports show 0 as a payment, I've got to count something unless they can provide documentation showing otherwise. And if they're not able to get a hold of the student loan servicer, what we do is have them go to the online calculator, put in specifics of what their new income will be with their job outside of residency, or if they're a resident, they can actually use that, and use the income-based repayment plan deal, number dependence, what state they live in, and whatever that is for the income-based repayment plan, we're able to use that and put that into the file. So it's been nice to be able to not have to, have them be on the phone or trying to get a hold of somebody. They just go online and do that. The thing that's interesting about student loans is most guidelines will say they have to show that the student loan is deferred for 12 months from the date that they close the loan. It's almost impossible to do that with regular guidelines, because say that they were going to close in June and they were just renewed or something in February. Well, you're not going to be able to get that in that document showing they're deferred for another 12 months. And so it's difficult if someone has 0 for a student loan and that's what they're expecting. We can't do that. We've got to go in and use that income rate based repayment plan, just because of how the system's set up and how they renew those deferments every year.
So I got to imagine that there's some do's and don'ts. And so for the listener who's looking down the road and trying to figure out what they need to do to prepare, what are some tips that you can give, like what we should do, what we shouldn't do to prepare to put yourself in the best situation? You obviously are trying to do it. Banking is trying to help them get into a home as easy as possible. But what other things can they be thinking about?
Well, I just think talking to a lender up front, it's never too early. I just did a seminar over in Fort Worth for residents, and there's always a couple of residents that we have that try and buy homes where they're at, And I think that's great. But unless they have a spouse that's working, it's difficult to get residents approved with just one income if they're making that, $60,000 to $70,000 a year. But it's never too early to explore that and see what's available, or once they're, going to get their attending job, what that entails. I've got another great thing that we do with our physician loan that others may not, is we're able to get, in most cases, somebody that's coming out as a 1099 right out of residency and still get them approved. And at least in the Dallas-Fort Worth area, most of the emergency room physicians are 1099 from the word go, because they have to go to, many different hospitals. They're going to have different pay scales at those hospitals. And so, if that's the way it is, we've got to find a way to be able to get them a home. As long as their contract says they're guaranteed, making this up, but this is what most contracts say, 2,080 hours a year, and you're going to get paid $215 dollars an hour at X hospital and $350 at another, we can come up with those income
together.
Exactly. And it's a little arbitrary, but because they're considered self-employed, we're going to put a 20% haircut on that for expenses, because you can write off things as a self-employed person. And that's what we use as a tool to help get them approved if they're going to be, a self-employed individual from day one. And
what are the biggest mistakes you're seeing people do?
Well, I think that they're trying to go and pay off a bunch of debt right away without talking to somebody, to think their credit score is going to have to be a certain level. We do have the lowest credit score for physician loans with no difference in rate in the industry. They can go down as low as 670, 670, and still get the same rate as somebody that has an 800 score and still have the availability to do the zero down up to the 1.5 million if they wanted to. So I think that people think, well, I can't get a loan with a 675 credit score and student loans that are going to come due in 6 months. They've closed the door before they've even opened it to take a peek and see what we can do. So I just like to, and sometimes it's just a 5-minute phone call. It's just, hey, what are you expecting your salary to be? Where are your student loans? Where's your credit score? And if I can give them the confidence in that 5 minutes that there's a product for them, then they'll open up a little bit and say, hey, I'm thinking about an 800,000 sales price with zero down. What are the payments on that? And that's pretty easy to put some things out there and go, well, if you're looking in Austin or Fort Worth or Houston, Dallas, wherever it may be, we look up the tax rates. We can have a reasonable expectation of what insurance costs are going to be and get them some numbers so they have the tools to know, hey, if I'm looking at something, this is something that can be affordable to me. So the first step to me is always, let's just have an initial call. And I'm not talking, much time. Give me your 5 minutes in between your class if you're a resident or whatever your shift is going to be, and get that done.
Are you seeing many people trying to purchase too much? One of our business partners used to say residentiitis, right? That they want to go out and buy these big homes or cars or whatever because they well deserved it, but it would just waited so long because they've had to defer. And so they, go out and maybe try to buy too much. Are you seeing that at all? Or do they buy right in their zone, buying more conservative?
I would say most physicians are more conservative in nature with what they're buying. And I don't know, you guys can ask or answer this for me. Are they still getting advice from financial planners to say, hey, go buy that as large of a house as you can because it's protected from any malpractice? Or is that something you guys don't even talk about?
I know that it's creditor protected in Texas, but that's the only time that's the only part of that statement I've ever heard. I don't know that I've ever heard somebody say, go get as much as you can.
I've heard it more from attorneys.
Right?
I
think you're right.
Attorneys. The financial advisor primarily is going to be, let's save money, investing. Let's leave some margin in your life to do some other things. And
you have another thing to catch up on. It's called savings for retirement, right?
Yeah, you're going to eat something one day. Yeah, something.
That's right.
But attorneys, we hear a lot of times, hey, they can't take the house. Go ahead and pay the house. And then they have these arbitrary stories around where that's benefited. people in different states, but it's still
Well,
out there. It's the thread, the story people go back to sometimes. But typically,
yeah,
as an advisor, that's
it's not
we're
what
not
you're
going to get
doing.
on that bet. Yeah, yeah,
Exactly. And so I think that you guys are doing your job because for the most part, we're getting people that are reasonable in what their expectations are and what they want for a house. There's probably one in 50, Paul, that come to me and say, I want this right now, and it's just not available to them. But what you have to do then is put a plan in place. A lot of people say, that the ones that maybe are looking for too much right now, they're saying, well, my wife is going to graduate from residency in 6 months, and her expectation is she's going to make X amount of dollars per month. Without a signed contract yet, I can't arbitrarily assign something. So we still go through the numbers and say, hey, when your wife does graduate residency or your spouse graduates residency and they do get a contract, here's what you can afford. And for the most part, people understand that. But that's what it's all about is telling them, here's what you can have available when that contract is there.
Yeah, I think I would probably be on the opposite end of that spectrum in terms of conversations I had. Hey, maybe even wait a year,
yeah.
because the reality,
Yeah.
one of the things you mentioned earlier is that while they're not going to necessarily change their specialty, you might not like the employer that you're going to work for. And I've
Yeah.
seen that
Or
happen.
that side of town, or the traffic, or the school.
That's
Like
right.
so many variances happen when
Most of
they're
these people are
just
moving to
from
cities
town.
they
Yeah.
haven't even been to, right?
Yep.
And they're checking it out, like the employer, like there's nothing. I've had people I've talked to that have gotten snake bit. They're like, I bought this house, I hate this employer, and I'm moving. And then it becomes a catch-22 because they want to leave, but then they can't really stay in that town because I have contract issues with where I can go practice or stipulations where
repayment issues, all sorts of things.
all
Yeah.
sorts of things
Yeah.
going on. So I just
Yeah.
I think that absolutely get it on, but land, see if you like it there. There's a chance that you
Yeah.
may leave, and while buying a home isn't permanent, there's a way that you can step in it and take a big hit right off the bat. So I think just being a
Yeah,
little
but
patient.
yeah. And the people that do step into homes right away, I think some of their thought process is, well, I'll be able to lease this if I want to move quickly. But if you are doing a zero down loan and the interest rates where they're at, you may not be covering your payment on that with where leases are at now. So it
Yeah.
is dangerous. But I have seen several of my customers, they're buying a house where they're a resident with the help of maybe a parent or something that has means. Then they're buying another house when they're going to their fellowship somewhere else, and they're looking at it as a tool to say, by the time I'm going to buy my real house as an attendee, I have a couple of assets here that are creating some income for me as well. But again, it's all about, are you able to cover that payment? When rates were 2.75%, heck yes, you could. But that strategy is probably a lot different for people now that you're up in near, let's just call it between 6 and 7%.
Yeah.
The other way we see things is, or people that maybe are trying to do too much, is when they have a guaranteed 1-year salary and then they go to a revenue-based sharing system after 12 months. For us, that's a unique situation that we have to really look hard at. And we do have a solution for that. Say you're going to make $350,000 for your first 12 months. Well, a logical person is saying, I'm not going to go to the revenue-based system if I'm going to make less. It's only a stepping stone to make more, because it's, for lack of a better term, eat what you kill. Well, we don't know what that's going to be in year 2, but if we can get a letter from an employee saying, hey, the employer saying, hey, in year 2, here's what our average year 2 salary is, or year 3, that's what it is. If we can get that letter, we can go with that and create an income flow for them as well.
Well, it sounds like you're working to create good programs that are beneficial even in the high interest rate times. I like the advice around, looking at the ARM mortgages, right? That seems to make sense to me. I'm sure there's situations that maybe 100% of that doesn't make sense, but doing that, look at the physician loan. It sounds like it's never too early to start really kind of planning for it. Doesn't mean go shopping. I think that's the dangerous thing, is you start looking at homes and falling in love with things, and then you just got to have it. It's always a slippery slope. So I agree with you 100%, Tony, about, see what you can afford. And then the other thing too, is that you may qualify for it, but all the other things that you may have coming and going on that you're trying to navigate through, you may not want to have a high house payment that big. So trying to figure out what's really going to work well for you is probably a good place to end up. The questions we like to wrap the show up with is around the title of the show, which is the patient physician. And so I would just pose that to you. And I don't think we, warned you in advance, but what would you say when you hear that the patient physician, what that means to you?
What that means to me is what you just kind of said. It's something where
no, you can't steal mine.
He's like, that is brilliant. I'm going with that.
Nope. Yeah. You got to make up your own stuff.
I think it has two meanings. One, I think the patient physician means these physicians really work hard to create a good customer base and do all the things that you need to do to be a good physician. But I think it's also what you guys do is our financial planners. And so what you're trying to tell these guys is, you may not have everything you want day one, but come with us. We're going to put a financial plan in place to get you where you want to be. And sometimes that takes a little patience.
Always does. Yeah. That's the hard part is constant deferred gratification.
Yeah. Am I near what you're looking for there?
There's actually not a right answer to that. It's always, that's the great part, is it's subject to interpretation. So I always love to hear the feedback on it. Well, listen, Tony, thank you so much for your time. We'll post your information in the notes and encourage people to do their homework as you're looking to get a home loan or get a home. Make sure that you're doing the right research and talking to people like Tony in advance. So thank you for your time, and best of luck to you.
Paul and Chris, I appreciate the opportunity to be here. And as always, really appreciate your partnership and the things that we can do together. So let's keep on keeping on, and I appreciate it. Thanks, guys.
You bet. Thanks, Tony. Appreciate it.